Okay, good morning again. This is Greg Reagan with the Milner Group, and we're going to go ahead and start the webinar. We're just fortunate to have Jake Bailey, who has been with us for almost 9 years now, and Jake is a CLU CHFC. He's our Director of Sales Support, and Jake has put together this webinar on a concept called smart money. So I'm going to turn this over to Jake and tell us all about smart money, Jake.
Thanks, Greg. I'd like to remind everyone on the call today that your lines are muted. They're going to remain muted for the entirety of the call so that things will be clearer. However, if you would like to ask a question, there is a message box, should be a message box on the bottom right hand of your screen, probably somewhere over there. You can type a message in at any time, and at the end of the webinar, those will be read to me, and I will do my best to answer them. All right. Well, I'd like to thank everyone for taking the time to be on the call today. I'm excited about our topic today because I think it creates a huge opportunity for your business. I typically focus on concepts that can be implemented with a wide variety of products, so I usually spend very little time discussing specific products. In this case, however, because the product is so unique, we'll be discussing one product that really makes this concept tick. It's a pretty simple concept, so I expect our call today to probably be a little bit shorter than usual. So let's get into it. What is the smart money concept? Simply, you're looking to reposition low-yield money. You're going to try to earn a higher return while retaining that low-risk profile, while retaining access to capital if your client needs it, and while also adding valuable life insurance and long-term care or chronic illness benefits. What are our goals when designing this? We would like for our cash surrender value to be greater than the single premium that we put into the contract in year one, so immediately. We'd like to achieve strong tax-deferred growth over time. We'd like to have an immediate death benefit, and we'd like to have that chronic illness rider. Those are our 4 main goals in designing an illustration for this product. What's the competition? What are you really working against when you're trying to sell this product? Well, you're really competing against low-risk investment yields, which right now is going to be fairly easy for you because the yields are so low. Treasury bonds, you can see, you're going to be earning 1%, maybe 2% if you go for a pretty long-term duration there. CDs right now, I looked for the best rates available, and pretty much the best you're going to get on a 3 years, 1.5, 5 year, 2.2, pretty low. If you want your money to be extremely liquid, best case scenario right now, 1% in a money market, and that's really good. Most accounts would be a good bit less than that right now. So what's the process in setting up a smart money sale, a smart money illustration? We're going to put a single premium into an IUL contract. So we're taking that money that your client may have on the sidelines in something like a CD or in a money market account, something that's earning a very low return for them. We're going to put it as a single premium into an IUL contract. We're going to use a minimum death benefit because we're trying to have the maximum cash value we can. Here's a big part of it. We're going to add the waiver of surrender charges rider so that your surrender value from year one will equal your account value. There's no surrender charge whatsoever. And with this particular product, which we're about to discuss, a chronic illness rider will be automatically included, and that's a huge benefit for your client. Okay, what is the product? The specific product that works for this, and it's a phenomenal product, is North American's Rapid Builder IUL. It really has all the pieces that make this work great. It's an index universal life. Their S&P annual point-to-point account has a 13.5% cap, a 0% floor, and 100% participation. This is a very good cap. Additionally, it has a 3% guaranteed minimum interest rate. Now, that doesn't mean that in any one year you couldn't earn 0%. What they're saying is that over time, they're willing to guarantee your client that you will not earn less than 3% compounded. So that applies any time that it applies every 8 years. and any time that you surrender the contract. So at any time that your client surrendered the contract, if they have it done at least 3%, North American is going to make it 3% compounded, and that's going to be their surrender value. Pretty strong guarantee. It makes me think that they don't expect the return to be anywhere near that. They expect it to do much better. Additionally, this product has a 50 basis point guaranteed persistency bonus in year 16 plus. North American is rewarding people that keep this contract for a long period of time. A lot of index products have a persistency bonus. However, this one is 100% guaranteed. So that's a really strong feature for this product. It has a waiver of surrender charges rider, which we add. We already talked about that. It's going to get rid of all surrender charges. It has a chronic illness rider. It has guaranteed wash loans in year 6 plus. We're not going to talk much about loans today because obviously with a single premium, we're creating a MEC contract. So we're really probably not going to be talking about taking loans out of it. It has a max variable loan rate of 6% guaranteed, which is excellent if you're looking to do a retirement supplement sort of sale. Also has overloan protection, which is great for that same reason. Keeps the client's contract from lapsing if they were to take out too much in loans, so they don't have an income tax problem. And here's an important point. It has a 0% premium load. Okay, so this is a very low-cost contract. That really makes it work for the concept that we're talking about today, the smart money concept. Okay, how does the chronic illness rider work? I want to talk about this a little bit because it's a very big benefit your clients get in addition to the death benefit, in addition to the cash value growth. Basically, like long-term care, the qualification is 2 out of 6 activities of daily living or a severe cognitive impairment. Has a 90-day elimination. Your client, when they're qualified, can take out an annual maximum of 24% of their death benefit up to $240,000. So if they have $1 million death benefit, they can take out $240,000 a year. There's no cost up front, so it's not dragging the contract's performance down. However, all contracts that don't have a cost up front for these riders, basically the payments you receive are discounted based on your life expectancy and the cost of capital. So your death benefit might be reduced by $240, but your client might actually receive $200. And there's a small administrative fee per election. Cash value is reduced proportionately to your death benefit. So if you had a 10% reduction in your death benefit, you'd have a 10% reduction in your cash value. Pretty straightforward. And it automatically issues on this contract through age 75 and Table 4. So most of your clients that you write with this product will have this rider. Okay, let's look at some examples, some actual numbers of how this situation, the rapid builder IUL with a single premium will work. So we have a male age 30, put in a $250,000 single premium. Okay, this is life insurance, so he has an initial death benefit of $1.4 million. And also, that's increasing every year. So over time, he's actually going to have a much bigger death benefit than $1.4 million. The year 1 guaranteed surrender, this is the worst case scenario. This is the 3% guaranteed rate, and assuming that North American would increase their cost of insurance charges in year 1. That part of it's incredibly unlikely. But even so, their guaranteed surrender is $254,008. So he got the insurance and made over $4,000 at the same time. Year 1 surrender, if the contract does 7%, remember that it has a 13.5% cap. So in this case, if the S&P 500 does 7% or better, that's what they would get, 7% or better. In that case, you'd have almost $265,000 surrender in the first year. Say it only did, okay, let's look at 20 years. At 7%, it'd be $826,000. Pretty incredible. If it only did 5%, you're still at $563,000. You've more than doubled your money over those 20 years. So here's what it looks like on a graph. I've got our baseline here at 250, which is our contribution. So you can see we always have a positive value for the client. They have not lost any money, even in the 3% scenario. And you can see over time that if the contract does well at all, say it does 5%, we're Looks like we're in the 550K range. We're over 750,000 in year 20 at 7%. Very strong performance. Let's look at somebody a little bit older, male age 50. I kept these all at 250. This would work with 100,000. It would work maybe with a little bit less. In this case, because the client's older, the same premium, we've got an initial death benefit of 720,000. Still almost 3 times the single premium they put in. It's got an increasing death benefit, so over time it'll be much larger. Your year 1 guaranteed worst case surrender value is 253, so we're still positive. Worst case scenario, year 1. At 7%, you're at 264, so you've got $14,000 gain in 1 year. Year 20 at 7%, you're at 780, over 3 times what they initially deposited into this contract. Plus, all that time, they've not put another premium in, and they've also had the chronic illness benefits in case they had a long-term care need, and they've had the death benefit the entire time. Say they only got 5%. They've still more than doubled their money. Again, on a graph, you can see we're always positive, even at the 3%. If we do better, it's looking great for the client. All right, so I know I'm going to get the question, well, what about somebody even older? So I went all the way to a 70-year-old, same scenario, and this still works very well. It looks a little bit different, but it still works well. We put in that same single premium. We've got 400,000. Death benefit's lower because the client's older, but again, it is increasing every year. Our year 1 worst case guaranteed surrender value is 248. So this is the first time we've seen that it's not actually greater than what the client's put in. But in this case, we've got a 70-year-old, worst case scenario, their coverage of $400,000 only cost them $1,500 for that first year, and that's the worst case. Say they did 7%, you can see we've made a gain. Year 20, we're at 670,000 at 7%, and at 5%, 451. Very strong performance, even at 70 years old. So at this point, he's 90 years old. He's got $450,000 of cash, even at 5%. And at that point, his death benefit would have increased from 400,000 to probably about 650 or so. So incredibly strong. Again, we can see positive performance every year. Okay, I wanted to show you an actual illustration from North American so you could see what this is going to look like when we take a look at it. In this case, I've got a female age 45. I lowered the single premium amount so we could see what that looked like. 100,000 in this case. You can see worst case scenario over here, the guaranteed maximum charges, which that's incredibly unlikely to happen, especially in year 1. Then we've got the guaranteed minimum 3%. Surrender value is 101,480 the end of year 1. So we've got a gain. We've got $380 to $395 or $96,000 of death benefit, depending on what the interest rate does. And here's one thing I wanted to point out. Even at 7%, if you look at a life insurance illustration with a cash value in it, I'm always interested in not what is the credited interest rate, but what is the actual return that the client is getting. Because you know it's not exactly what's on there because there's a cost of insurance involved. Well, here's what I wanted to point out. North American's cost of insurance is incredibly low, and they have no premium load. So I calculated, you can see my nice little painted in job here, 5.8% in year 15 is what they actually got credited to them if they return 7% inside the contract. So there's only a cost in there of 1.2%. And I've looked at a lot of products, and I can tell you this is an incredibly good deal. All right, so they got credited 7% average. It actually returned to them 5.8%. Very good. So I looked at several scenarios, and because of the zero premium load, the actual credited return is usually only 1 to 1.5% lower than the credited rate. So you can tell somebody, especially a younger person, it's usually towards 1%. So if the contract returns 6%, your actual return on your cash value is going to be about 5%. Here's another thing. The guaranteed charges, especially when you're younger, they only reduce the return by 50 to 100 basis points. So worst case scenario, you're only having 0.5% to 1% reduction in your total return, even if North American jacks the charges up to the maximum amount. Again, this is just a worst case scenario. Companies almost never do this, and North American has not done it. So how does this actually compare to another investment, in this case a CD? Remember, the CD is going to be taxable. Okay, when you get those that interest statement, you're going to be paying tax. MEC contract, which is what we're creating here, is tax deferred. So when you take money out, your gain will be taxable, but you have tax deferred growth. In this calculation, I took into account the 10% penalty that you would pay prior to 59.5 if you take a withdrawal from a MEC contract. So I've made this a completely fair comparison. I used 30% as the tax bracket for the client, a combined federal and state tax. You can see in year one, your 3-year CD at 1.5%, which is currently what it would pay, is $252,625. At 7% after tax, your life insurance contract would be almost $259, plus the death benefit, plus the chronic illness. 5%, it's almost $256. We look 20 years down the road, you've got $308,000 in your CD, assuming you reinvest everything every year. And your life insurance at 7%, after all taxes and penalties are taken into account, you have $638, more than double. If you did 5%, you have $458, $150,000 better. And this is with a product with a 0% floor and a 13.5% cap. I would say 5% would be conservative performance. And remember, at the same time, you've given your client that death benefit and the chronic illness rider for the whole time. So I'm sure you're not interested in this, but I thought I would point out how the commissions work on this as well. It's heavily weighted towards the excess premium. So the target premium will usually be fairly low because we're making this a minimum death benefit. So obviously the lower your death benefit is, the lower your target premium is. An interesting point here, North American does not reduce your commission percentage that you get paid on your target, that's unusual and it's very strong. All they do is reduce your target by 38%. So you take a 38% reduction in target, but they still pay out a very high percentage. So let's look at this. A male age 30, that one we looked at, your commission on that at street level would be over $8,000. Okay. That 50-year-old, almost 10K. And the 70-year-old is 14, well over 14,000. So the commissions on this are very strong. It's well worth your time to look at what clients you may have that have some money kind of sitting on the sidelines. And speaking of prospects, who are the people you should look for? Who is going to really work with this product? The ideal prospect. I would say under age 75, table 3 or better. So that's a huge swath of people right there. The reason I say table 3 or better is because North American has a table shave program where your table 3 clients can actually be shaved to standard. So in this case, I'm talking about a standard or better rate, age 75, is what the client is going to end up being. You're going to want them to have at least $100,000 in low-yield investments. This is somebody who's got money in CDs or some treasury bonds or something like that, maybe a money market account. And that money, importantly, they have a separate emergency fund. Why do I say that? Well, because they have 100% access to their money if they need it in this contract, but we don't want them taking it out immediately. We want them to have a separate emergency fund, and you need to discuss that with your client. There's a 3-year chargeback schedule, 100% in year 1, 75% in year 2, and 25% in year 3. After year 3, there's no chargeback for anything. So you want your client to have a separate emergency fund so that if they need funds for something that comes up, they don't have to go get it out of this contract. They could if they had to, but it'd be better if they did not. Of course, you want them to have a need for life and LTC insurance, and that is most people. So here's the conversation that I would have with the client. What if, client, I could get you a tax-deferred return of around 5 to 6%. I'm talking about the actual return here, not what the product is showing. I give you an immediate death benefit from 2 to 5 times your initial deposit. I could give you a chronic illness rider to cover your LTC needs. I could give you immediate access to over 100% of your initial deposit should you need it. Would you be interested in replacing your CD? This product is so strong that I think it makes this conversation a pretty easy one to have with your client. As we discussed, even worst case scenario, for a long time your client would not lose any money. And they have all these benefits included. And they have the potential to earn a very high return. Great contract. All right, that pretty much sums up what I had to say today about the smart money concept. I would be happy to answer any questions you have at this time. Okay. Dwayne, do we have any questions keyed up?
Yeah, we do have a couple. How do the numbers look when compared to a state life asset care?
It's going to be, you're going to have a higher death benefit, and you're going to have the higher potential for cash value growth. This product is an indexed UL, and it's going to, like I said, 13.5% cap. It has the potential to earn a much higher return than that contract. That's a good question because this does compare very closely to the asset-based products like the one you mentioned, also MoneyGuard, et cetera, all the products like that. It does compare pretty closely, except you have potential for a lot better performance.
Okay, and let's see, we had somebody, you can probably expand on this a little bit, but North American, I believe we have a 10% commission bonus program going on right now.
We do have a 10% bonus program going on. You submit a case with North American and you can get a 10% bump on your commission for a case, and that is on top of their already very strong commissions. I believe the street level on this contract that we're paying out is 90%. So if you use that 10%, you're at 100 on the target, so that's incredibly strong.
How does this IUL compare to others when funded regularly instead of doing single premium?
That's a good question. This product is meant to build up cash value very quickly. That's why it works for the smart, the smart money concept. So it works really well when you fund it over time. However, if you're going to keep it for more than, I would say, 15 years or so, and you're going to fund it over time, they have another product North American does called the Builder IUL. Just not the Rapid Builder IUL. It does better over time, a little bit better over time, and it doesn't have that waiver or surrender charges rider. So your client's cash value is going to build up a little bit slower, but it's going to be greater in the future. And these contracts have very good loan provisions, incredibly good loan provisions. I didn't go over them very much because that's not really something you're going to be doing with this single premium mech sale. But for a retirement supplement scenario, they have a great contract for that. This one works. I usually use this one for older clients because they need to build up money more rapidly. For somebody a little bit younger, and when I say younger, I'd say somebody, in this case, probably under 60 is going to want to use the Builder IUL.
Okay. How is North American able to offer a product so competitive?
That's a good question. I would say North American they're set up with a lot of great contracts. How exactly they're doing it would be a question for their product designers and the management of the company, of course, but all of their products are very competitive. It's not just this one. They have a guaranteed UL that beats pretty much every other guaranteed UL almost all the time. They have the Builder IUL, as mentioned, that is great for retirement supplement. They have this product that's great for putting a single premium into, especially. The only thing they have that's not all that competitive is their term insurance. They're really focusing heavily on this IUL market, and they have been doing that for a long time, and they're very good at it. They've incorporated all of the features that you would want your clients to have when you look at these contracts, and there's no hidden gotchas. So I think one of the ways that North American makes up for having such great products is their underwriting is very tough. They don't really give concessions. A preferred with one carrier, with almost all of our carriers, it might end up being a standard with North American. But even so, the products are designed so that still is very competitive. So I think a lot of it is that they make up for it with underwriting.
Let's see, I had somebody asking if slides are available. We certainly can get those out to you, and we are recording the webinar as well, so we can send those out if anybody is interested. Let's see, what is the minimum premium?
This is not like the asset care product or like MoneyGuard. There is not a specific minimum premium. Rather, there is a minimum death benefit. And the minimum premium you could pay is going to depend, of course, on how old you are and what your premium needs to be relative to that death benefit. So I can't give you a specific single premium figure, but I can tell you that the minimum death benefit is $100,000. For somebody that's younger, 30s and 40s, they could definitely get by putting in less than that $100,000 single premium. They might even get by with 25 to 50. But your typical client that's going to have that cash lying around that's in their 40s, 50s, 60s, they're going to need to put in more like 100 or more.
What determines the rate of return credited to the contract?
Well, the strategy I looked at is annual point-to-point S&P 500 with a 0% floor and a 13.5% cap. What does that mean? So January 1, 2015, you buy the contract. January 1, 2016, they're going to look at what the change in the S&P 500 has been. Let's say that that it's positive and there's been a 10% gain. You're going to get credited 10% because it's under the cap rate. Let's say that it had a 20% gain. You're going to get credited 13.5% because that's the cap. And here's the great thing about IUL. Let's say that it had a negative 20% year, just tanked. Your client's going to get credited 0%. In this case, over time, if that happened, your client would get credited 3% because that's North American's minimum guarantee.
Are there any amounts you can take out in the first 3 years without a commission chargeback?
There is, and I don't have the specific figures on the top of my head. I should have that. Whoever asked that question, if you would like to send me an email or give me a call, I'd be happy to give you the exact figures. But yes, there is an amount you can take out during the first 3 years without having any sort of effect.
How does this compare to a VUL?
Well, it's not a variable product, it's fixed. And so as a variable product, you could have potentially an unlimited gain, depending on what the market did. And you can also have unlimited losses in some cases. This product is hedged by options, as all index products are, so it plays in a certain range of returns. You can have nothing less than 0 in this case, and you can have nothing greater than the cap, 13.5%. So in my opinion, it's a less volatile product than a VUL is. Your client doesn't have to worry about negative returns, but they're also not going to get a huge, 20 or 30% return or whatever. They're going to get capped out at 13.5%. It's more conservative.
Okay, it looks like we had somebody interested in copies of the actual illustrations themselves, Jake. But they were also curious if they could, I guess if you had any sort of simple presentations you would use in front of your client for this concept, or whether you just use the one that you went over today.
No, I would not use what I went over today. That is meant for agents only and to give you education on the process. For your client, North American does publish information on this. This is actually smart money is actually a North American concept. And no, I was not paid anything by North American to do this. North American really does have the only product that really works great with this. However, they're going to publish client information, so we could get a presentation from them that would be client appropriate. Feel free to email me if you would like that, and I'll get it for you. As for the illustrations question, I'd love to run you an illustration, but give me a call or shoot me an email for that, and for a particular scenario, I'll get it together for you.
Let's see, you said 3% credited over time. Over what time?
3% compounded annually over time is what I should have said. So that just means that if you surrender the contract, or every 8 years they look at it. So say that in an 8-year period, for some reason, S&P 500 is negative every year or below 3%, North American is going to come back and credit your contract 3% annually. compounded, okay? Or say that you keep this contract for 5 years and then you surrender it. Well, they're going to do the same 3% if you've done less than that over the 5-year period. So as with any interest rate quote, the figure that you're quoting is an annual, on an annual basis. So 3% a year compounded annually.
And let's see, what are the underwriting requirements?
Depends on your age. For most people, it's going to be a paramed exam, blood and urine. You're a little bit older, you'd have to have an APS, etc. Depends on the face amount, too. There's nothing unusual about the underwriting requirements, is what I should say.
Let's see. Does the 3% guaranteed rate include the max COI charge? If the rate of return was 3%, would the cash value be higher if they didn't charge the max COI?
Yes. Yes, and you could show that on the illustration. I chose to run 7% with a 5% midpoint and then 3% with the guaranteed max rate. If you showed the 3% guaranteed minimum interest rate on their current charges, yeah, it does better than what the guaranteed charges would be. And that's a good point, because that is likely to be your worst case scenario. Companies hardly ever raise their cost of insurance charges on the clients. However, they're not going to be controlling that interest rate very much. So what if it did 3% over time? It's probably going to be 3% with the current charges rather than the guaranteed maximum.
What if you surrender after year 1? Would you still get the 3% if the S&P had been 0?
Yes, you would. And that's the numbers I showed. I think for the male age 30, it was you put in 250 and your surrender in year 1 was 254 at 3%. That's with the max charges. I don't know what it was without the max charges. It probably would have been something like 255 or something like that. That's your worst case scenario. So say the S&P is negative, and your client also has buyer's remorse and decides they want to get out of this after the first year, they're going to get credited that 3%. And they're going to have in most cases, they're going to have a positive return. If the client is much older, like 70s or older, it's possible that they could, worst case scenario, have a very small cost.
Do you feel confident illustrating North American at 7%? Or would it be better to show clients 6% or 6.5%?
If it were my client, I would illustrate it probably at about 6% because I'm very conservative. It really depends on what you expect to happen over time. We have a 13.5% cap and a 0% floor. If the market performs like it has historically, 7% inside this contract would be easily attainable. However, if you think that maybe the market's going to grow a little bit slower, or if you think maybe North American would bring their cap rate down, which they haven't done, but they could do, just like any company could, then you would try to illustrate something a little bit more conservative. For me, I would show the client 6%. I'd show them probably 4.5% on the midpoint, and then there would be the 3% with the guaranteed maximum charges as the worst case scenario.
All right, I believe that's all we have for now.
Okay, great. Thank you, everybody, for being on the call. Thanks for your time, and I hope that you have a great day. Please give me a call or send me an email if you've got any questions or would like to see an illustration. Thanks.